And welcome to today's webinar, Tax Credits and Deferrals through FFCRA and CARES. So as we continue this weekly webinar series, as we talk about all the nuances, all the stimulus packages, the compliance, all the issues, HR issues that surround all this coronavirus and how we as small businesses and HR and payroll people need to respond. So let's go ahead and jump in. So first I want to talk about what's in today's webinar, what's not. So what we're specifically going to talk about today is really three things. If you've attended our previous webinars, you know the FFCRA, that's the Family First Coronavirus Response Act. That was the first piece of major legislation that passed back in March that had all kinds of rules and regulations to give employees, as more employee-centric, giving them the ability to take leave and get paid leave, especially for larger companies, so they could take care of sick people, their family, little ones, and if they became sick themselves. And then came along the CARES bill, which really enhanced FFCRA, but also had a bunch of stimulus and regulations and things specifically for small businesses. And so if you've been watching the series, you can see off the right-hand side what we're not going to cover today is a bunch of topics we already have, where we've really done deeper dives into CARES, into FFCRA, what they are, what kind of leave is available to employees, how you track it, who's eligible, etc. But I think appropriately, a lot of the time and energy has gone in this last, call it, say, 3-4 weeks to stimulus dollars where the big dollars sit, right? Which is PPP and EIDL. And really most of the energy and the oxygen in the room being sucked up by PPP. And that's going to continue to be for a while. So we're going to continue to have webinars and content around PPP. We're still waiting for some more updates. And in this latest piece of legislation that has not gone through the Senate yet, but it's been proposed in the House, has some major updates that will impact and amend the PPP CARES Act. So lots more to come. But what we're going to talk specifically today is, I think, some pretty valuable stimulus for small and mid-sized businesses that has been kind of in the shadows behind PPP and EIDL. So it's the FFCRA tax credits, it's the Social Security, the federal portion of your employer taxes in the form of tax deferrals, and it's employee retention credits, which is also a function of the CARES bill. So we're going to go through those three topics, and whatever time we have left, we'll take some Q&A. As always, a little safe harbor at the bottom here. We're not your CPA, we're not your bank, we're not your lawyer, but sure is filled with a bunch of experts in this field, which is kind of teeing me up to who our guest speaker and my guest today. So Lisa Carmen, she's the Vice President of Compliance here at Assure. More specifically, she is in charge of and runs the tax function for Assure. So for all of our clients who we are filing taxes for in literally thousands of jurisdictions, for thousands and thousands and thousands of clients, we're responsible for all that. So she knows this stuff inside and out. And one of the advantages we have as a company is Lisa has a board seat with an organization called the NPRC. That's the National Payroll Reporting Consortium, where we participate with all the household names in the payroll HR industry. And it's a nonpartisan, vendor agnostic organization that they just help IRS, Department of Labor, and other government organizations to give them guidance, consultation about how to most effectively implement the laws that they pass. As you can imagine, between FFCRA and CARES, these are some of the most major HR specific legislation to pass in decades, and it'll happen within 30 days. Congress does their best to pass laws that help their constituents, but they don't know the first thing probably about running a payroll, right? So rubber hits the road when you actually have to execute against these laws. And so the NPRC and people like Lisa help guide IRS, Department of Labor, on how to implement these rules in just practical, common sense ways that make sense for all of us. So I say all that just to know that we assure, more specifically, Lisa Carmen speaks from a position of authority, and coincidentally, Lisa also has a whole bunch of years in the industry, so really knows this topic. So with that, Lisa, I want to welcome you, and let's go ahead and just jump into our topics, talking about
great.
the tax
Thanks, Mike.
credits and deferrals. So first thing, we're not going to PowerPoint everybody to death today. We're gonna have a conversation. So the things that I want to explore with the tax credits, these have really been around since March, late March, when FFCRA first passed. But so much of the focus at the time, a lot of us weren't even in shutdowns yet,
Right.
and first dealing with the pandemic, right? And so a lot of it was around leave management. How are we going to track leave? Who's eligible for what leave? But share with us, maybe remind us, what is the stimulus that's available as part of the FFCRA tax credits?
So, Mike, you hit it right on the head. So this was really when things were just coming about. Not everybody was shut down, and there was more questions than answers, which seems to be our norm in this environment. But what we focused on at that time is, the FFCRA was an act that required employers to provide employees with additional paid sick time or family leave time, specific to COVID related reasons, or for childcare reasons. So daycare was shut down, the schools were shut down, that kind of thing, or if you had to care for a child or family member that had either symptoms or was diagnosed. So we focused a lot on that, and obviously for good reason. What we didn't focus on was there really are some tax benefits in providing this time to your employees. So although it's the compassionate thing to do and the right thing to do to allow your employees the time to heal themselves or take care of their families, there was also a benefit to the employer in doing so. So this one was specific to employers with 500 employees or less. And there was 3 buckets of time off required. There was the 2 weeks or up to 80 hours of expanded medical leave. And that was at the employee's regular rate of pay if they were unable to work because they themselves were either experiencing symptoms, waiting for a diagnosis, or had actually been diagnosed. And then there was another 2 weeks or 80 hours of family leave, and this was family leave to care for another individual that was subject to quarantine, under doctor's orders, to care for a child, whose school or daycare, whatever, shut down. And then on top of that, an additional 10 weeks that went above and beyond. Now, this was for employees. The first 2 were for any employee. The third one was for employees that had been with you for 30 days or greater. And that provided an additional 10 weeks if they needed to leave to care for a child due to COVID-related incidents such as, schools closing, sick children, etc. Homeschooling is a whole new thing for a lot of professionals that are used to going to work and letting the experts take care of homeschooling. So this allowed for that.
Yeah, so Lisa, fair to say when FFCRA passed, everything related to FFCRA was really the impact was for below 500 employees, right?
Correct.
CARES has stimulus for large companies and small companies, but the initial play here from the government was really focused on small businesses. So can you maybe talk about eligibility, and just for our listeners here, all of this is in print on our website. So go to suresoftware.com/COVID-19 and you can find all the copy of the explicit rules, including Department of Labor guidance on all this. So that's why we don't have all the text. Trusting you can hop on the website and read just one of the commentary around it. But maybe talk about the stimulus availability of, say the below 50 employees who may or may not participate.
So, Yeah, there was a small group for under 100 employees that may be exempt from this, but that, I mean, it was just not a quick buyout. Hey, this is going to negatively impact my business. I can't give you sick time. You really had to think long and hard about it, ensure that you're not discriminating against an employee because they needed to take this time off. And it had to significantly impact your business, and possibly put you out of business if you had to pay for this additional time off or be without these employees. So it is good for, part-time employees, and you just average their hours to get to the eligibility for the time off you need to provide. And then also, obviously full-time employees. And in this case, they're kind of loose about it. In the full-time employee category, generally they work 40 hours per week. Whereas when we get into employee retention credits and such, they really want to, specify that, it's a minimum of 30 hours a week and 130 hours a month, et cetera. So overtime's included to get to the, average of hours worked for a full-time employee. And that's where we get into this. So, where you want it to go here, Mike, I think is, how does it work? How is this?
Right. So basically under 500 employees, everybody's got, unless you can prove out that this would, basically cripple your business to have to pay, you're a company that doesn't provide PTO, vacation time, and it would, you simply couldn't write the checks. So maybe there are some exclusions, but for the most companies who by law all of a sudden had to provide this leave, whether whether there was budgeted for or not, how does the tax credit portion of this work so they can kind of recoup some of that expense?
So those employees are entitled to a credit in the full amount of the required sick leave and family leave, in addition to related health plan expenses and the employer's share of Medicare tax on that leave. And as you said, this kind of rolled out around March. It became effective April 1. And this was the biggest question back then, is when is it really effective? So it's April 1st. It runs through December 31st. That refundable credit is applied against certain employment taxes on your wages paid to those employees. So what you can do is reduce your federal employment tax deposits in anticipation of that credit and request in advance of that. You can use the IRS Form 7200, which is a new form. Super easy, and I don't say that often about any form that comes out of the IRS. There's, a few lines on it, very clear as to what goes, in those fields. And believe it or not, they will accept that form via a fax only. So hope you all have a fax machine, but
Yeah,
that's
welcome to the 90s. Holy cow.
Yeah, right. So that's a good way to get those advance credits, or if you're not set up, with a payroll provider, that can help you with that. So remember the caps though. So these family leave wages that can be taken is limited to $200 a day per employee and $10,000 for all calendar quarters. So there's the cap there. And it is 100% tax credit. 7,200 is easy to use. Some payroll providers have it set up that they will track it, via an earning or a deduction, which is, what I would strongly recommend. And that allows you to track the credits against your payroll. If the credit is greater than the tax liability, you can submit it on the Form 7200. You'll receive a paper check from the IRS at some point. There's no real clear, data on that. And then there are also a couple things that are, new that just came out as recent as May 4th. So they've updated the 941 to allow for this to be reported on the Form 941, but there's also a Schedule R attached to the 941 that includes the information about the credits, the qualified sick and family leaves. It'll cover everything, the OSCI referral, the employee retention credit. So another form that we'll be filing, another form to create and update. So I mean, it's fairly easy. If you set up an earning deduction code that you can track it, super easy to apply it against your liabilities. If you don't want to do that and wait, for your 941 or at that payroll period, you certainly can do the 7200s, and you can submit multiple Form 7200. Just do not cross quarters with that form.
All right, so real quick, back to the dollars. So regardless of, so how does it work when you got an employee, maybe a low earner versus high earner? Because the cap is $200 per day and 10,000 for the entire period, right? So the
Correct.
April 1 through December 30th, that the 10,000 is per person, correct?
Per person, and that's all 3 quarters. So first quarter is kind of out because it didn't go into effect until April. So
Right.
the $10,000 would cover the 3 remaining quarters of the year.
So if you have a really high earner, you got a $200,000 executive, their vacation time, and they took all the time, they exercised all of the time available to them in FFCRA.
Mm-hmm.
You might have to pay more than you would get reimbursed. Is that accurate?
Yeah, it is. It is. If they're that, high of a rate of pay, yeah, they would hit that $10,000. And the $10,000 is the cap that you receive the tax credits for. So yes, you may be giving them time off that exceeds that $10,000 mark for sure.
Yeah. Okay. So that's kind of an outlier for most small businesses. Not a lot of,
Yeah.
Maybe some owners draw some good incomes, but very few people on their staff that earn that kind of money. For the most part, when we talk about the $200 a day cap at the $10,000 for the 3/4 cap, is it an automatic 200 and 10,000, or is it just the dollars in which, so you get reimbursed dollar for dollar that you paid in that leave type?
It is dollars for dollars. The 210,000 is just a cap that's applied to it. So if you come in less than that, you have a low earner, you're only going to get the credit for the amount that you paid.
Got it. Okay. And then 941, probably a whole bunch of people on this phone call know what that is, but those who don't speak and live tax all day, every day, we're just talking about the quarterly employer tax form, right?
That is correct.
Yeah. And so lots of changes coming in the 941, right? If I remember right, it's an 18-line form that is getting 18 lines added to it. Am I saying that right?
That's correct. Double.
Yeah, so talk about that, because you mentioned the Form 7200. So what's just to keep us 8th grade for everybody, including me on the phone here, what's the difference between the 941 and the 7200, and what do we do until the new 941 is available?
So the 941 there's a draft available. It is a draft form, but I would say it's pretty much complete. They actually did a nice job on it. So it's the quarterly tax return. So we won't be filing that till into July. So they anticipate that the final form will be ready June 30th, which means we're going to be, in a mad rush. However, we'll start on it now. We'll deal with the changes that come along as they do. So that is your quarterly payroll tax return. There will now be places, within those new 18 lines to report these FFCRA credits, and then as we get into the employee retention credits and the Social Security deferral. So there's space available on that. The Form 7200 is a form specific, to the CARES Act, and allows you to collect that same data for any tax credits related to FFCRA, the employee retention credits, and the Social Security deferral, to request those credits now. So if you didn't want to apply it against a payroll, or the credits exceeded your payroll liability for that period you're looking at, you could submit the overage via the Form 7200. If you're a weekly payroll processor, you could submit it every week. It just asks that you do not cross quarters, and just make sure if you're submitting the form that you have not applied it or failed to remit those dollars on your payroll processing. So it's one or the other. If you're using a service provider and they're going to apply those credits for you. We're just going to debit that much less of your tax liabilities and not remit those because they're being excused right now. That makes sense, Mike?
Yeah,
Okay.
it does. So we're going to revisit. So you're going to hear, everybody on the phone is going to hear us talk about the 7200, Form 7200 through all three of these, right? Because that's going to be the mechanism in which to report.
Yes.
But as the supplement to the 941 quarterly tax return, you're going to declare this credit.
Correct.
All right. So before we move on to the next topic, then. So just to kind of recap. So FFCRA, this thing kicked off in March. The world was trying to figure out what the heck's going on. Passed this law to protect employees in their incomes if they have to go take care of sick loved ones, or if they get sick themselves and have to miss work. This is before all the world shut down in most states anyway. And so it really was not a kind-hearted way to look at it, but from an employer standpoint, it became a financial burden that you're going to have to all of a sudden be paying for leave that wasn't part of your budget. This was the mechanism that I think a lot of people don't understand is the way to get that money back, right? And so really long-term, your only exposure is for highly compensated folks. For most employees, if you submit the Form 7200 with your quarterly tax returns, that whatever you had to pay out in this new FFCRA leave, you're going to get back in the form of tax credits. Am I saying that right?
Pretty close. So the 7,200 you would submit prior to filing your quarterly returns if you want an immediate credit. If you are going to report it on your 941, that's all you need to do if you choose to wait till quarter end and take that credit against your federal tax liabilities at that time. If you want it now, use Form 7200.
Got it. Really important clarification. So the 7,200 means that you get the credit on every time you would process payroll and then have to otherwise pay those taxes, correct?
Correct. That's right.
Yeah. All right. So hopefully that clears that for everybody. So let's go ahead and move on to our next topic.
Okay.
Lisa, I think that was a really good discussion. So the next one is Social Security tax deferrals. And you know, there's what's the acronym OASDI? You want to tell it? So it's technically it's the OASDI deferrals, but what is that? Old age, safety. Help me out with the acronym.
Yeah, you're going to stump me on it too. It's and I just had it on the tip of my tongue. You messed me up. Oh crap! Let me get it. I should know that off the top of my tongue. Anyway, it's
old age, safety, disability insurance, maybe something along those lines. Yeah. All right. So flipping ahead from FFCRA. Fast forward a few weeks to the next big sweeping legislation with CARES. And with CARES, obviously the focus was on PPP for obvious reasons. So, and will remain for quite a while. But what are the tax deferrals available as a function of CARES? And I think maybe specifically for as it relates to or as opposed to PPP dollars.
Okay. So this one, you can defer and deposit the payment of the employer portion of Social Security taxes and certain railroad retirement taxes. All right, so those are any employer, and let's keep in mind on this one, this is a deferral. This is not a tax break, if you will. It's going to let you, take the time you need to, get back on your feet here. So part of this is, if an employer received a PPP loan or a Paycheck Protection Program loan, they may no longer defer the deposit and payment of their share of Social Security that's otherwise due after you receive a decision from your lender that that loan was forgiven. So up until you do, you're still eligible. So even if you've got a PPP loan, if it's not been forgiven yet, you may still defer. Once you get that notice that your PPP loan is going to be forgiven, then the deferrals stop. So another point on eligibility for this one, Mike, this is for all employers. You don't necessarily have to be adversely impacted by COVID. So if you choose, hey, I'm just having a tough time, and maybe COVID made it worse, or maybe it didn't matter, you can still take advantage of this deferral.
In not just whether you've been impacted or not, any size, right? So FFCRA focused on the under 500. This is for all sizes.
That's right. Yeah. Yeah. So you want to talk about what
let's get into, so how does this one work, right? Because it sounds simple to say, oh, great, I'll just temporarily stop paying my the federal portion of my employer's federal portion of their taxes. But how does that work, with quarterly filing? And what if I'm doing this mid-period? Somebody on today's webinar, this is the first time they're learning about it, and so they're hopping on the phone, this afternoon, tomorrow morning with their provider saying, "Hey, I didn't get, I didn't get PPP. I'm not getting PPP. I want to at least hold off on paying these and defer these to 2020. How does that work?"
Okay, so it applies to the 6.2% Social Security. And I got it back, old age, survivors, and disability insurance tax. All right, so yes, so OASDI. So it's the employer's portion only. It does not apply to the 1.45% of Medicare. So just to clarify, it's just Social Security. So a lot of people, I think you've heard refer to it as the Fica deferral. It's really just a Social Security deferral. So this one was instituted March 27th, 2020, goes through the end of the year. And so same thing, same process here. If you opt in to defer these taxes, you can take it against your Social Security liabilities on a payroll processing. So if I'm running my payroll today, I want to opt into this program. Our system will calculate that for you. We'll, flip a flag, if you will, to say, hey, I'm taking advantage of the deferral, and then we'll calculate and carry that amount forward so we can report it on the 941 later that I opted to defer, this amount is outstanding. So you can take that deferral amount payroll by payroll. You can submit it on the 7200 if you don't want to, process it against tax liabilities. I mean, to me, the advantage is do it along with your payroll processing, and then we just net that amount out. So we're not coming to hit your account for it, or your payroll processor is not, and we'll track that credit for you, and well, not credit, the deferral for you, and then apply it, to the 941 at the end of the quarter. This one, so as I said, it's a deferral, it's not a credit. There's expected payments. The first 50% is due on December 31st of 2021, and then the remainder of it on December 31st of 2022. So you do have a good long period of time to pay this back, but just know that it's not a credit.
Yeah. All right. So this one thrown in really from a P&L standpoint, maybe not a huge help, but for just business who is struggling, maybe it's a larger business who doesn't qualify for PPP. Maybe it's a company for whatever reason can't get forgiven for maybe they're in a shutdown situation and they got their loan and they're 8 weeks burned up before they could spend the money. Lots of different reasons why this might be the case, right?
Yes.
At least it's a mechanism, it's a lever to help with cash flow is really what this amounts to.
It is, and just another point on that, you can also take this deferral against wages that you've paid on the FFCRA time off. So not only can you take that credit on there, you can defer the FICA for the amounts that you go over. Not the FICA, the Social Security.
So explain that more detail if you could.
So if you are having to pay, leave credits out and time off as part of the FFCRA and the sick time, either the 80, the 2 hours or the 2 weeks or the 10-week period of time. So you have that $10,000 cap there. You exceed that cap, you can take the Social Security credit against the wages that are over that cap, if you will. So those wages are not excluded for this. So it's kind of a, you get the best of both worlds there.
So it's not a double dip because this is really for just the dollars that exceed the FFCRA tax credit caps.
Yeah, because the others you would already be taking the credit on
Right.
immediately. Yeah.
And so with FFCRA, it seemed like there's a new update from Department of Labor every couple of days. But how solid ground are we on here with the Social Security tax deferrals with CARES?
This one I think is pretty solid. Other than the revised 941 and the Schedule R that goes along with that, which is just really the detailed layout of the credits or deferrals you're taking. This one has been, it seems like it's been around forever. It's been around for a couple months. It's pretty well stabilized. I don't really see anything, new here that's, probably worth digging into.
So this is kind of bedrock as far as the coronavirus legislation world is concerned. It's 2 months old and hasn't changed. Okay.
Yeah, and keep in mind it's still going to be alive. It seems like the cases are dying down, and probably your workforce is stabilizing. However, you could have somebody that has a relapse, or you personally get sick, your kid gets sick. So this goes through the end of the year. So if you get sick later, or your kid's still out of school come September, you can still take advantage of this.
That's a really important point. Maybe we should talk about that at the top of the discussion, especially with FFCRA, right? So not so much specifically the Social Security deferrals, but I mean, obviously we went on, the world went on shutdown, different start dates, different end dates. Plenty of people still shut down. Where I happen to sit right here in St. Louis, we open up back on Monday the 18th. So we're getting there in most places. Yeah. But no matter where you sit politically, I think everyone acknowledges there's going to be more people get sick throughout the year. There's no vaccine, right? So people are going to continue to get, which means people are going to need leave. People are going to need to take leave to take care of people, which means you get past this PPP wave. These things are probably going to start taking center stage as the remaining levers that a business can exercise. So it's a really good point.
I'd agree with that. And that being said, it's really important to track all this. So, it might seem simple right now. Maybe you had, one employee that had a childcare issue and needed to take a couple weeks leave. No big deal. You're past it. You're over it. I would strongly encourage you, whether you think you're using these programs a little bit or a lot, I would strongly encourage that you take advantage of the systems put in place to track these hours and dollars that you're paying out, track the credits that you're taking, the deferrals that you may take advantage of. So if this comes about and you need to deal with it again later in the year, it's just a cumulative total, and it just keeps tracking quarter over quarter. So come the end of the year, you're not scrambling to pull your data together.
Yeah, that's really smart, and so as an HR oriented company, we would guide against, having all kinds of well-written policies and procedures to protect you from areas like this. But, there's a lot of companies, I think, just the modern world where many companies don't track this stuff like they used to, right? You don't have the hardcore rules, and we want, maybe at a company to have more of a friendly, come as you go, take whatever time you need without punching a clock culture in many cases. But if that is your culture, it's still the HR in me wants to guide people to, hey, at least have written policies of what that does and doesn't include. But in lieu of that, in context to today's call, still, if they're taking leaves, regardless of whether you tracked it before, track the time, right?
Yeah.
Because this is stimulus that is available to you as a business.
Yeah, because if you want to run your business like their family, and people we work with become our family, we spend more time with them, than we do our own families. You can still do that, but by tracking this stuff and taking advantage of it, you can probably do more for them because you're going to have, some financial relief.
Yeah, right. Okay, let's we got time to go on to our third topic here.
Okay.
And hopefully we've got a little time for questions. So the last one here is around employee retention credits. I think this is maybe the least understood of these three buckets. So why don't you just start us out? Obviously, we know when CARES came out, so we know timing. But just first tell us what is the employee retention credit, Lisa?
So this one really is about retaining your employees. So this one is a refundable tax credit against some of your employment taxes. This one is limited at 50% of the qualified wages for an eligible employer. This one started March 12th. So this one, they kind of backdated because it did come out later, but this one goes back to March 12th and runs through December 31st also. So everything runs through the end of the year. This one just started a little bit earlier. Pretty similar to the FFCRA credits, you can get immediate access to the credit by reducing your tax deposits that you would otherwise, be required to make, as you're processing payrolls. And then same thing, if the tax deposits aren't sufficient to cover the credit you have due, you can get an advance payment from the IRS. Same form, 7,200. One form does it for all three of these. Or you can roll that credit to your next payroll and say your liability is greater on the next payroll, but you've got this, $1,000 left over from the last one. You can roll it forward. Again, you can submit that form 7,200 multiple times. Just don't submit it after the 941's prepared, or you'll be crossing over that, and you're going to have tax reporting issues with your friends at the IRS.
So talk us through the calculation in more detail, if you could. So it's the employment taxes, not wages. It's employment taxes equal to 50% of the qualifying wages, right? So just describe layman's term what that means.
So the employee wages are limited, this one also up to $10,000, and that determines the 50% credit. So you can get up to a $5,000 flat credit per employee. And that goes through the end of the year. That is not a quarter by quarter $10,000. That is through the end of the year. So wages, including certain health plan costs, health care that you're paying for, even some that the employee are paying for, up to $10,000, you get 50% of that. So you can get up to a 50% credit. But before we dig into that further, Mike, let's just talk about the eligibility real quick.
Yeah.
So these are employers, but you have to qualify for it, right? So you either need to have a full or partial suspension of your operation or your business during any calendar quarter because of government orders limiting commerce, travel, gatherings, business openings due to COVID-19. So this one is specific. You have to qualify in that you're full or partially suspended, or you have significant decline in gross receipts. And that decline is measured by the first calendar quarter in 2020, which your gross receipts would come in at 50% or less of your gross receipts from the same calendar quarter in the previous year, so 2019. So if you had a bank first, second quarter of 2019 and second quarter 2020 hit you hard, you would likely qualify for this, but receipts. And then that decline stops in the first calendar quarter of 2020 that your gross receipts are at 80% or greater of what they were in 2019.
So you're a business services company. You sent all your employees home. You took a little hit. You're down 10% in revenue. This doesn't apply to you. You're a restaurant. You had to shut your doors. You're doing curbside service, but your revenues are 10% of what they were before. This applies to you, correct?
That's correct. Yep. Yeah. So take that in mind, because you're going to have to likely prove it out. So take the time to, run the calculations, make sure you really do qualify.
And so it's 50%. So talk us through the dollars again, though. So the cap is up to what, 5,000 per employee?
Through the year. That's correct. Yeah.
And so is this just an automatic for, so what if I had 100 employees in Q1 and I brought 10 employees back throughout the rest of the year and I got 10 people on my payroll? Am I getting $5,000 per times 10, so $50,000 for the year? Or do I have to bring all 100 back? How does that work?
No. It's for your existing employees. So the idea is to give you a tax break so that you can fund your payroll. So this one's not specific. You got to keep X number of employees employed. That's more around the PPP loan and how you get that forgiven. So, this one doesn't include the qualified sick leave. So if if you're paying employees for that time, that's not included in this tax credit. So you could, it is your, so it's your current employees, so you take their wages up to $10,000 for the year, calculated as you go. It includes, healthcare expenses. So if you're paying on their medical, you can include those costs as well. So if you've got some low earners and you're not going to get, to that $10,000, you can add in those expenses.
Very good. So this is just so everybody knows, unlike the deferral, this is not a, hey, I get some relief until later. This is more of a real-time relief for those people to get money to help fund, and then therefore the word retention, to retain those employees.
Yeah. Great. So this would, apply to, federal income tax withholding, employees' share of Social Security and Medicare taxes, employer's share of Social Security and Medicare, for all employees up to that amount of the credit. And so no penalty, there's no, late remittance or late filing fee with this. It's excused.
Very good. All right. Boy, we're at 1:44 Central Time here. I want to have a couple minutes for some Q&A if we can. So real quick, is there anything that is like, here's what we don't know, we're waiting for clarification on as it relates to retention credits?
I think this one is pretty clear too. There was a lot of question about, how we were going to report this, and it is going to be reportable on the 941 starting, second quarter. It was not available to report on first quarter, although there were some wages that would have been impacted going back to March 12th, because they kind of backed this one up. So, we'd have to take into consideration that credits can roll forward. So if you don't have enough in, that one particular pay period to cover, you can roll them forward to the next, or you can submit the Form 7200 for an immediate credit via a paper check. So if it were my payroll, I'd be running it along with my payroll and reducing my tax liability. So I really do get it immediately. The biggest thing that's new on this is there was a big question if a payroll reporting agent, which would be, a payroll processor, would be able to complete, sign, file, and remit on your behalf. That was a big question. It has very recently come out that has been authorized. And the requirement would be, much with, other reporting, 941s, et cetera, you would have to have a Form 8655 on file from a client to do that. So if you're working with a payroll service provider, you're going to need to provide them with your 8655, which you probably already have, and they can complete, sign, and remit this form on your behalf, and it would be filed quarterly along with the 941. Same thing, you can submit the 7200 multiple times. You could submit it with every payroll processing if you choose to do it that way, just not after the 941's filed. So don't cross quarters.
Very good. Okay, let me take a slide here, share some of the additional resources. We'll see if people have some questions here for us, Lisa. So as always, if you've been attending these, you'll know we built this site, suresoftware.com/COVID-19. Tons of resources. There are a bunch of webinars just like we have, like this one today, that are all recorded. They're free of charge. Just go ahead and click the link. You can watch them. Don't need to fill out forms or anything. They're really there for tools for you. Also, plenty of other resources, payroll and HR best practices, how to disaster-proof the payroll function. There is an ebook called the COVID-19 Survival Guide, specifically designed for payroll and HR departments and how to deal with the pandemic, and then also how to return to work. And certainly there are some incredible offers out there, one of which is literally free HR. No long-term commitment. You're not going to automatically be billed and stuck into a long-term contract. We have different levels of HR support, including online library access, call center, all the way up to a completely outsourced virtual HR function. Some of the online and call center capabilities have been offered for 90 days for free. So, you know, you're opening your business back up, you got HR questions, you can talk to certified HR professionals on the phone or access the online library, no commitment necessary. So check out those offers. By all means, regardless if we ever do business together, check out the site. It's designed to be resources that help you, regardless, you know, no obligation, including we have links to essentially, so certainly every state in the US, in most of the major US cities, all of them have a COVID site that have their specific guidance, their health orders, their recommendations, their laws, etc. So all the resources that we can we've compiled for you there. So with that, let's jump to Q&A. We've got about 10 minutes here, Lisa. Let me pull up and see what questions. As always, if you have, we've got a bunch of them I see. In the GoToWebinar tool, there is a questions section. Submit your questions there, and we'll do our best to get to these. All right, first one. When there's a moment at the end, can you touch on how to access recorded webinars? That would be awesome. Okay, that was not a plug. Go to the website, suresoftware.com, COVID-19 /COVID-19. It's also right in the top navigation in the menu. You can find it there. All right.
Yeah, I'll add to that, Mike. There is a lot of detail. The first few webinars we did, in particular on FFCRA and CARES, we don't usually like to do a PowerPoint with a lot of data in it, but I will say we really clearly outline those programs, you know, what the credits are, what the eligibility is, what all the different, you know, the various sick leaves and extended time off leaves look like. So there's a lot more detailed information than we went into today. And as I said, it's recorded, so you know you can hear us talking about it, but you can also read it and have a point of reference for that.
Very good, thanks, Lisa. All right, so I'm seeing a bunch of PPP related questions. So mostly I'm going to refer you to the recorded webinar for how to maximize PPP forgiveness. I'll read this question and kind of speak to around the edges and ask for you to as well, Lisa. So we were told we had to bring back any employees by June 30th that are laid off. After the 75% we had to retain, what if we have to lay them back off before forgiveness happens? So PPP is a separate thing. 75% of the money of your loan dollars have to be spent on payroll for the entire loan to be forgiven. You can still have forgiven dollars if you're less than 75%. But can you talk maybe, Lisa, how these three programs we talked about, so the FFCRA tax credits, the deferral, and the CARES retention credits, how those do and don't relate to PPP?
So, I mean, the idea around all of them are to free up the resources that you can continue to make payroll and keep your employees employed. The FFCRA gives you the 12 weeks time off period. They would just be off. They would still be considered an employee. You've not terminated them or laid off. So you would still have that employee on the book. And, Mike, correct me if I'm wrong here, but the June 30th date is, I know that was a date if you significantly reduced an employee's wages by greater than 25%. Those had to be reinstated by June 30th.
Yeah.
You do have.
Yeah, we're kind of. I think the question. Forgive me if I'm wrong. I won't reveal the name, but if I'm misreading it, I apologize. I think commingling some concepts. So bring them back by June 30th. That's specifically tied to PPP loan forgiveness.
Yeah.
That you had if you didn't have their wages whole, so you have to have them back. Period. Within the 8-week period of the PPP. But
yeah, so that's where I was going. You got to be within that 8 weeks of when your loan was funded.
Yeah, but if your PPP 8-week window ended prior to June 30th and you were below and you had a wage reduction of more than 25%, as long as you committed to returning to those wages by June 30th, the way it's written is you would still be forgiven. Now that's going to be between you and your bank how you prove that out, because they're the ones who have to certify to the SBA that you did so. But I think separate topics. All right, let's see if we can take one or two more here.
Yeah. So to get to that number though, let's say you have 200 full-time employees and 50 part-time employees. You have 250 employees. But for the purposes of forgiving the loan, they use a standard full-time equivalent employees to get to that. So you don't have 250 full-time employees. You could extrapolate that out and take the equivalent. So those 25, part-timers could be 50 part-timers could be 25 full-timers. So in essence, your count would then be 225 employees or FTE equivalent.
Yeah. And I just want to say thank you, Jason, Jeffrey, Mike, Monica, for filling me in with old age survivor disability insurance.
Yes,
excellent.
Thanks.
Yeah, passed the test. Great. All right, let's see if we can take another. Boy, almost all. We're going to have to do some more webinars on PPP because almost all these questions touch against. Let's talk about employee retention. It's a simple question. How is employee retention defined, Lisa?
So it's I mean, this one is not contingent on it's a refundable tax credit against your federal taxes, and it's intended to give you immediate access to those funds. It's not specifically saying, to take advantage of this, you have to keep 25 of your full-time employees. It's giving you access to those funds you wouldn't have because you would be making a tax payment with each payroll or soon after, depending on due dates. So they're not requirements. I mean, the idea is if you have access to those funds, you continue to pay your employees, you get to take a credit on that employee with the next payroll run.
Lisa, here's one about timing. I think I know the answer, but I'll give that to you. So to qualify for the CARES employee retention credit, the employee is based on the second quarter, question mark?
So it is, I mean, the qualified wages go back to March 12th. And obviously that was, first quarter. None of this was defined during that time. So there's going to be a catch up in second quarter that, we'll have to report on it. So the employees, the credits you can take against those employee wages go back to March 12th.
Okay.
Then,
Here's another one.
there was no guidance at the time, so you couldn't file it with first quarter. So we'll have to do a catch up on that.
Got it. That makes sense. All right. So to confirm, I can take the credit for FFCRA if someone was out for the 10 days, even if I have the PPP loan or it's forgiven as well?
Yeah, the FFCRA, yes. Yeah, where the PPP comes into play is if you're doing the Social Security deferral, once you get notice that your loan is forgiven, you may no longer defer.
So think of it this way, and at least keep me honest here if I'm stretching this. So
Okay.
PPP is designed to get people off unemployment, hopefully prevent you from laying people off in the first place. If you already did, that you bring them back as quick as you can, get them off unemployment, get them a paycheck.
Sure.
It certainly is more complicated than that, as some people earn more on unemployment than not. Some people don't want to come back. It's very nuanced. But if you brought people back, you got your PPP loan, and you still had to pay for someone to take leave, that wouldn't be different than vacation pay, right? That it is still a type and a form of wages, right? The same as commission, vacation, paid holiday. It is still a form of pay. That's why it would count as part of income, as part of your PPP forgiveness. So
yeah, the only part that would be excluded from the PPP forgiveness would be any tax credits that you had as a result. So you would absolutely be able to take advantage of the wages that you've paid out. It would just be reduced by any tax credits that you took, which, I mean, the wages are obviously going to be a lot greater than the taxes.
So in this person's questions, I'm going to repeat it then, because I think it's important clarification. So to confirm, I can take the credit for FFCRA if someone was out for the 10 days, even if I have the PPP loan or it's forgiven as well, question mark.
That's correct. And it's a requirement. It's not a choice to give them that time off. You really have to allow them to take those 10 days.
Well, but I think the question is about the credit. So I'm just going to make up math. So if I have to pay somebody $1,000 to take 10 days of leave, and I get that $1,000 back in the form of an FFCRA tax credit, I can't double dip and get that $1,000 and have another $1,000 from PPP forgiven for that $1,000, correct?
Right. Yeah. So just the amount that you get in the credit, you would not be able to use as, forgiveness for the PPP. The total amount would be reduced by that credit amount. Yes, that's correct.
All right, so Tanya, hopefully we answered that for you. I think a safe assumption here is if it looks and feels and smells like double dipping, you can't, right?
Exactly.
Would be a safe way to look at it. Okay, I know we're at time.
And
Tons
we'll
more
go
questions.
Questions again. If there's any that we missed, we're happy to, send out an FAQ to answer them. And we'll have, I think you have contact information there. Is that right, Mike? That if I didn't clearly state that to Tanya, we could follow up.
Yeah, you bet. So we'll provide a mechanism for that in our follow-up. So lots of questions. I'd say the majority of the questions I'm seeing are two buckets. Number one is around PPP. We're going to have at least a handful more webinars just on this topic. I know that I think I'm going to wait probably another week or two, just because I'm kind of waiting on some additional guidance here, and I'm anticipating the bill that's currently in the House of Representatives. I can't imagine that in its current form is going to get through Congress and on the president's desk for signature, but there are some pretty compelling components in that bill, one of which impacts when the 8-week PPP timeframe starts. Specifically, I know it's a real issue for many small businesses that 8 weeks window starts today when you get funded, even if you are currently shut down and can't put your people on the payroll, because you would be paying the federal portion of those taxes. It would literally actually cost you money to take advantage of the benefit. So that's a real issue, and part of the current legislation, aside from $3 trillion in programs, is a rule change to PPP. So, I think a bunch of us are rooting for small business on this one. That I'm assuming Congress, the House, and the Senate are going to arm wrestle a whole bunch, and it's not going to be $3 trillion worth of programs. It's going to be some dollar amount smaller than that, narrowed down specifically to probably COVID specific programs, but kind of hoping that will be a major rule change. So it's probably going to be a week or two before we have another PPP forgiveness webinar. I'm going to wait on a little bit more clarity on guidance before that one comes. And then the other bucket of questions is just availability of this presentation. So we're recording this whole thing either later today or tomorrow morning. This will be available on the website. So assuresoftware.com/COVID-19. It'll be right in that page. Can't miss it. And then look for upcoming webinars where we keep educating everybody on these topics. I wish everybody the very best, and thank you for your time.
Thanks, Mike.
Thanks, Lisa.